Today, household finance confidence slumps in February. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today we look at the latest results from our household surveys, and specifically on the results from household confidence. Each month we ask households about how they're feeling about their finances, whether they're taking more loans, whether their deposits are rising or falling, what their income is doing, and overall their position with regard to their properties and also their net worth. And we put all this together into our Household Financial Confidence Index. And the index also can be decomposed to look at the different dimensions that support it. So first, let's look at the overall index. And this is a chart of the index from December 2013 to today. And what's interesting about that is that we had a considerable dip through to 2015, and then the index recovered after that, reaching a peak in 2017 before falling again. And it's been falling now consistently since the middle of 2017 to reach a new low today, 86.5. Now that is actually the lowest point in the index across the whole of the time we've been running this analysis. And by the way, the 100 is a neutral setting. So you can see that since 2013, households have spent more time in the doldrums than not, which is quite concerning. Now, the next thing we're going to look at is the Financial Confidence Index by the household age bands. And we've seen consistently since 2013-14 that younger households, those aged 20 to 30 and those aged 30 to 40, have tended to have less levels of financial confidence relative to the rest of the population. Now that's partly because more of those are renting, but it's also because their finances are under greater pressure relative to those in middle-aged. But it's also worth noting that those who are older, so 60 plus and 50 to 60, still are relatively confident compared with those in the younger age groups. But it's also worth noting that those aged 20 to 30 are now showing the highest levels of concern about their financial status. And when you look at that in more detail, it's simply because their cost of living are rising, their incomes are not, and many of them are either paying significant amounts to rent or significant amounts for mortgage repayments. Now we can then look across the various states, and again there's some quite interesting stories here insofar that traditionally it's Victoria and New South Wales who've contained households who've been consistently more confident. However, we've also been noting that after the recent dip in Western Australia, there's been a convergence towards confidence being much more equal across the states. And indeed, in the last few months, the confidence levels in Victoria and in New South Wales have come to the lowest point through our series. And there's been a little spike up in Western Australia. But it's worth remembering, of course, that 100 is neutral levels of confidence. So this chart tells us that the levels of confidence are below neutral in all of the states that we look at. The other thing we can now do is to look at it by property segment. And again, we can compare the property active households with the property active investors and the property inactive. Property inactive people are people who rent or live with family or friends. And we saw that through 2006 and 2007, there was a very significant rise in property holders and investors as property prices ran higher. But now that is turning around, and we've got to the point now where property investors are less confident than those renting. And even those who are property active owner-occupiers are now below the neutral setting. And this is simply aligned to 2 points. Firstly, home prices are falling consistently now in most states. And of course, that impacts both owner-occupied property owners and property investors. And in some places, rental streams are also slackening. In other words, rents are going down. And because of that, those who are renting are becoming a little more confident, but they are still below the 100 level. So another way to think about this is that the fall in property prices and the fall in rentals are adversely impacting more households in Australia. Now we're going to look at the Household Financial Confidence Index by our wealth segments. And here we're looking at the free affluent segment. These are people with property but no mortgages. Those who are mortgaged, whether investor or owner occupiers, and those who are renting. And the interesting thing here is that we saw consistently a rise in confidence amongst those with mortgages and with property through 2006 and 2007, before they started to decay as property prices fell and as lending became tighter. And we also see a little spike up in those who are renting, particularly over the last 12 months, and that is explained by the fact that for many, their rents are actually going down, or there's more choice in certain markets. But the other point it's worth making is that now all three of our wealth segments are recording confidence levels below the neutral 100 setting. And that's very significant, bearing in mind the elections that are coming up in the next month or two, because it's often the free affluent households who are more likely to support the conservative side of politics. And this tells me that many of them are relatively uncomfortable with what's been going on and the future outlook. So this may well have an impact on the election ahead. Now, what we're going to do now is to look at the elements within each of the components of the index. And the first is job security. So here we're tracking whether people are more secure, less secure, or about the same with regard to their jobs. And what's interesting here is until relatively recently, there was little change, but now we are seeing a significant spike in those feeling less secure about their job prospects. And what's fascinating also here is that it's the construction sector who's registering the biggest concern, particularly traders who now have less secure job outlooks because there's less work in the pipeline. And we're also seeing those with multiple part-time jobs beginning to be more concerned about the future of some of those roles, and that is specifically related to the retail sector. So I think it's true to say that job security is now being eroded thanks to the weaker economy, and it's the construction sector and it's retail and indeed the residential housing market that together are all putting pressure on job security. Next, we look at savings. And here we ask the same question: are you feeling more comfortable or less comfortable about the savings that you have? And again, for quite a lot of the series, there was a significant registration of about the same, but now people are feeling less comfortable with their savings. And there are two aspects to this. Firstly, they're running down their savings because incomes are not meeting their expenditure targets, and as a result, they're having to raid their savings. And the second element here is the lower interests being paid on deposits. So in fact, people who have got savings in the banks are now finding that that income is reducing. And in fact, in the last year, we've seen a significant drop in both term deposits and call deposit rates as the banks manage their net interest margins. And of course, recently what we've seen is that rather than lift mortgage rates, they've tended to drop term deposit rates. And that's now coming through in our data today. And it's also worth reflecting that those who are feeling more comfortable with their savings is at the lowest level it's been through the years we've been running the survey. And now we turn to debt. And we see quite a consistent pattern. In the early part, since 2015 to 2017, there was a consistent pattern of between 60 and 70% of households who felt roughly the same about the debt they had. But that's now changing, with more households feeling less comfortable with regard to the debts that they hold. And that discomfort comes from two areas. Firstly, the size of the debt. It's actually got significantly larger because mortgages have got larger. And there are also significant commitments with regard to things like auto loans and some credit card debts. And the other aspect is that the ability to repay debt is now more difficult because incomes have not risen significantly recently. And of course, the broader financial pressures on households are there. We've already reported that in our mortgage stress. And again, it's worth highlighting that the more comfortable blue line is sitting right down at the bottom of the page, and it's its lowest level through the years we've been running the survey. So debt is a significant problem for many households in Australia. Now let's look at the cost of living. So here again, we track whether people feel that the costs are higher or lower, whether they've risen or fallen, or have stayed roughly the same. How comfortable are they feeling? And now what we're seeing is a consistent rise in the cost of living. So households are recording the fact that the cost of living have been rising consistently. And that's true based on the CPI data that we've seen too, because we know that the cost of living, even officially reported, have been between 2 and 3%. Of course, many people will say that that CPI number doesn't really reflect the true costs of things like electricity, rates, childcare, school fees, and a whole bunch of other cost items, including healthcare costs. And the other point here to make is that those who say that their cost of living has stayed roughly the same has fallen consistently so that it's now sitting at the lowest level through the series. And so now looking at income, the question is, has income risen or fallen or stayed the same over the last 12 months? And there's a consistent pattern here too, with a greater proportion of households, the orange line, saying that their real income has fallen. And this is consistent with other data that also makes the point that in real terms, most households across Australia has not seen any increase in income in the last 5 or 6 years. And while some say that their incomes have stayed roughly the same, a little over 40% say that, you can see that there is just a small rise, around 5%, of those who say that their incomes have actually risen in real terms. And some of those relate to the recent wage awards that were made for low-paid workers. And finally now we look at net worth, which is essentially the assets that you have minus the debts that you hold. And again, because of the fact that property prices have been sliding, despite the fact that the stock markets have recovered quite a bit over the last couple of months, many people are now recording that their net worth in real terms is lower than it was 12 months ago. In fact, we've got to the point now where there are more households sitting on lower levels of net worth than 12 months ago than those with higher levels of net worth or those with about the same levels of net worth. Now, this is a very important element, in my view, of the so-called negative wealth effect. Now people are feeling less wealthy because property prices are falling, and that means that they are going to spend less at the shops, they're going to hunker down, they're going to become more conservative in their spending habits. And whilst there is a small proportion of the population who are doing very well with very high levels of income and high levels of discretionary spend, in the round, they are not sufficient to support the overall economy. And this is why the GDP number was weak this time around, and why we think the GDP number ahead will also remain weak. And so to summarise, this is a very significant finding from our surveys, that household financial confidence is as low as it's been through the whole series. And we know the reason why. It's to do with property prices falling, it's to do with high levels of debt, it's to do with flat levels of income, it's to do with the job markets coming off from their peaks. I wouldn't be surprised to see unemployment start to rise in the months ahead. And frankly, as we go into the election, I think there are some very important conversations to be had. Of course, whether the political parties want to have these conversations is a different question. But it does seem to me that we should be discussing the level of debt in the economy. We should be discussing the low wage growth. We should be discussing the high costs in the economy at the moment. Because we know that more than half of GDP is supported by household expenditure. And currently, from our confidence index, it looks as though households will keep their wallets firmly in their back pockets. Now, of course, we'll update the index again next month and continue to track these trends as they develop. And before I go, just a quick reminder, our next live stream event is scheduled for the 19th of March, that's next Tuesday week, at 8 p.m. Sydney time. And you're welcome to join us for a live chat discussion. You can ask questions and I'll try and answer them, or you can send me questions beforehand via the DFA blog, and links to the blog are in the comments below. I hope you'll be able to join me on the 19th. If you found this useful and informative, please do like the post, share the post, and add a comment or question. I read them all. And if you haven't yet subscribed, do so by ringing the subscribe bell to receive alerts next time we release a post. I'm Martin North from Digital Finance Analytics. Many thanks for watching. I'll talk to you next time.